Hi, Kevin Byrne here with the Byrne Real Estate Group. Let's talk about what the heck's going on in the real estate market right now. Obviously, there's a lot of uncertainty happening based on, interest rates. Interest rates have gone up significantly from a year ago. We were at basically 3%, 3.2% about a year ago. Now, we're looking at 7.5% on many, 30-year fixed. So that is a challenge for all of us. So how is that going to affect the real estate market? So first, let's talk about interest rates in general and how they affect real estate and a lot of things in general in terms of being consumers. So what is the Fed rate? How does it affect everything? It doesn't necessarily have a direct correlation with consumers because it's what banks lend and borrow from one another. That's basically the Fed rate in terms of, what they're going to be lending or borrowing money at, what percentage. And right now, the Fed rate, we're looking at somewhere between 3.75 to 4%. Now, obviously, banks are in the business of making money, so they're going to lend at a higher rate than that. And really, interest rates in terms of mortgages are tied to bond rates. So anyway, there are a lot of things that go into relationship with that, but a lot of times when they increase that rate, especially that significantly, it does affect mortgage. So let's take a quick look. I'm going to show you, really what the currently things are doing here. I'm going to pull up just kind of an example, an article that I was reading from, I believe, CNBC. So we're talking about right now, the Fed raising the rate here. How does it affect us? You've got credit cards, the annual APR, somewhere between 18.16 to 19%. I mean, pretty amazing. If someone has a credit card balance of $5,000 at 19%, you're going to be paying an additional $1,100 in interest compared to a 16% APR. I mean, that is significant, right? That really hits you in the wallet. Now we talk about auto financing. Now, again, you're looking at, increase here, 60-month loan will likely increase to 6% from its current 5.6. How that work out? That's an extra $34 a month on a $35,000 car. Again, not too many $35,000 new cars. So that's going to slow down people purchasing or being able to afford a new car. I was listening to someone earlier who said in some states, especially big trucks, they're paying over $1,000 a month for that vehicle. Over 25% of the people in Texas have over $1,000 car payment. Pretty crazy. Now we look at mortgages. We're somewhere between 7 to 7.25%. And I'll show you an example just in a second of how that affects people, especially in Boulder and higher price point areas. So that's pretty significant. And then you're looking at, HELOCs, any variable loans adjusting upward as well. Those are going to be at 7.3 or so. Again, every little bit comes into play. And we're looking at an inflationary environment where cost of goods, whether it's food, housing, fuel, all those things are also very expensive. So it's becoming increasingly difficult for people just to survive right now based on what's happening. Obviously, the Fed raising the rate is trying to slow down inflation. The inflationary rate, right? The peak was in June. We were at 9.1% year over year, and now we're at 8.2% year over year. So, the preferred central bank preferred rate is at around 2%. So we've got a long way to go to reel in inflation. It's pretty crazy. So let's look at just an example real quickly of the average sale price a year ago in Boulder, city of Boulder, was $1,153,319. So at an 80% loan, 914 would be the loan balance. At 3.16%, your payment would have been $39.32. Not bad, right? You're living in almost $1.2 million house, and your mortgage is about $4,000 for principal and interest. Now the interest you're paying is about $500,000. So again, not terrible at that low rate. Now, if we look at, where it is as of September of this year, not October. We don't have those that in yet. But the average sale price was $1,230,000. So it's gone up a little bit. It probably will go down as we move forward in the year. But a loan at 948 at 20% down at the current rate of 6.25. And that's on buying down the rate. Now, if it was at 7%, it'd be a heck of a lot more. Now let's look at that 5837. And your interest is now $1,153,000. So another $650,000. Now, if we took that up to 7%, if you weren't buying down the mortgage rate, now you're looking at another $500 a month and another $200,000 in interest. So you can see, obviously, as you're buying larger goods, it becomes significant in terms of this shift upward in terms of interest rates. And you can only imagine in an already expensive marketplace how many people might get priced out. Now, obviously, if you take it down to lower price points, you're still talking about a significant percentage increase in terms of what's happening, in the marketplace. So we look at those. We've got a long way to go in terms of healing inflation down to a more preferred rate of 2%. We're currently at 8%. And again, they're saying they're going to continue to increase. We've got another Fed review in March, and I think they're going to probably increase. I mean, all the experts are saying that they're going to increase rates again. So just buckle up. Now, if we're looking at what do we expect in 2023, let's take a quick look at that. I'm going to share a screen here in terms of what's going on. Okay, so if we look at kind of a forecast for 2023, most people are still assuming, based on the supply and demand, even though we've seen a sharp increase in the last few months, about a 25% increase in homes for sale, and a huge diminishing demand on the other end, that prices will still increase marginally in 2023. I'm not sure about that. I'm looking at what we're seeing in the current marketplace: price reductions, lower prices, softening market. And we do have some people who are starting to become not as bullish on the market, more bearish. And so some people are saying, to expect a decrease. Now, we've already seen a decrease from the peak in March of this year. So again, a lot of the experts are still a little bit bullish on the market. I'm not sure if that's going to be the case. Now, if we look at appreciation and depreciation forecasts over a much larger, volume of individuals, we're looking at, again, most of the people, 618, are saying they assume some type of appreciation, even if it's below 1%. And while some are assuming some depreciation. So again, it's about a third of the people are saying depreciating market, about 2/3 are saying that they still do expect an appreciating marketplace. Number of analysts, kind of the same thing in terms of, people looking at appreciation versus depreciation forecasting. Again, that's across the country. This is a national study. So there are some micro markets you have to kind of dig into to figure out supply and demand. So again, forecast through 2024 and 2026, this is optimistic. So again, we do like that over, the next, let's say 4 years, that most people are very bullish that, as we're coming out of the recession, which we are heading into, that we will be looking at, an optimistic appreciating market over the 6 years. So, the shining star is the equity. So households own about $41 trillion in owner-occupied real estate, just over 12 trillion in debt, and the remaining 29 trillion in equity. So that is fantastic. If we look at kind of state by state, you look at Colorado, you're looking at about $76,000 appreciation over just the last few years, year over year, and about 60,000 year over year nationally. So here's kind of the forecasts. If we look at the home equity report, again, over the last year over year, $60,000 in equity, about 27% year over in terms of the increase in equity. Percentage increase in equity for U.S. homeowners with the mortgages. And we're looking at 3.6 trillion in equity, across the country. So let's look at this. This is a really cool stat. It looks over, since 1991, the appreciation rates across the country. So you're looking at Colorado at almost 600%. One of the top performing states. Utah has been, gunning. You can look up here, Montana, Oregon, Idaho, some of the higher ones, some of the lower ones. If you kind of look across at some of the states, you got Delaware, only 200%, Illinois, 167, Indiana, Michigan. Again, some of the lower appreciating states where there still may be some value out there, obviously, if you're an investor. Now, we also have to look at what's happening in rents. Rents have gone up significantly since, the 90s as well. So again, is it more affordable to own or rent? That's really going to be the question, going forward in the next couple of years. So again, the advantages of home ownership: security, stability, privacy, personalization of the home, health benefits, just more stability, and financial, obviously, education in terms of managing a budget to make sure you can afford it, and kind of civic participation. You're now a homeowner in a community. So again, that's what is happening when we look at what's happening over the next few years. So next year, most people are still saying slight appreciation. I think that may change as the interest rates go up and up. I think people are going to get priced out in terms of just affordability. There are options. Let me say, like, who should be buying right now? Anyone who can afford it. From that standpoint, if you can afford with the current interest rates, you're going to pick up equity, especially over the 4 or 5 year period that you might own it, versus renting. So again, anyone who can afford to get in, we're also seeing sellers doing concessions to help you buy down the interest rate, whether it's points on a 30-year or whether it's a buy down for a 2 or 3 year period. So you can have a much more affordable, mortgage. And then hopefully if interest rates come back down, once inflation is slowed down, the interest rates may go down as well. And then you can refinance. So there are a lot of options. So again, for buyers, anyone who can afford it, great. If you're a cash buyer, now's a good time. You probably find some values out there in the marketplace. Why not buy? I mean, if it still continues to appreciate, now is a great time. And it's a slower market. People aren't sure how to react to all this. So definitely cash buyer. Investors, I'm sure, who have the cash or are looking at investment properties. I'm looking at investment properties. Really, the capitalization rates haven't increased much over the last few years. So again, as rents increase, and I don't think, a lot of landlords have adjusted those adequately to the demand, I think there's some great opportunities in the investment side as well, especially if you're cash, you don't have to finance because those rates are high. So if you have cash, great. Now, as a seller, who should be selling? People who are downsizing. Clearly, if the market does soften and there is an issue or a shift here where we do see significant price decreases, then now's the time. If you have a big house, you're looking to downsize, you're going to be buying cash anyway. You're not going to be looking at finances. Now's the time to sell. Now, if you're also in an area where demand can be very volatile, mountain properties. I had a property, someone had a very expensive property outside of Golden in the mountains, and it was $1.8 million house. I tried to, provide information so they would see that the market would be collapsing based on demand, and it has. So someone who could have got 1.8, maybe it's 1.6, maybe it's 1.5. They might have lost $200,000-$300,000. They're like, well, we don't know where we want to go. Hey, if you're relocating from an area that has, volatile demand, mountain property, you've got to be very careful, especially if this is, one of your larger investments. Now might be a very good time to get out. You're still riding the wave of the increase over the last few years. And if it does shift downward, you're talking about a major loss. You got to look at this as an asset, not necessarily personalize it. Hey, my kids grew up here. You got to distance yourself from that. So again, if you're downsizing from a large house to a smaller house, hey, I can't find anything. I get it. Rent short term. Is it worth putting another couple $100,000 in your pocket? Probably, right? I know that's a difficult decision because there's some uncertainty to that, but there's some uncertainty to what's happening here over the next 2 years, especially if the Fed keeps jacking up the interest rate. Demand is going to go way down. And if you're just hoping for that miracle California buyer with all the cash, I don't care, right? Like, please, that's just unrealistic. So again, who should be selling? People who are looking to downsize, maybe cash out of the marketplace, move to a lower price area in the country. Folks who can afford it, obviously, who find their dream home that's available right now and you can afford it, go for it. I mean, now's a great time to buy. And again, you might be able to refinance in a few years and drop that payment down and be sitting in a very good financial position with some equity. So the forecast for 2023, I think there's a lot of uncertainty. I'm not, when I look at what the experts are saying, and especially with what I'm seeing in the market, I do think there's going to be some depreciation in the Boulder and surrounding area in 2023. I don't think it's going to be significant. We have one of the most solid marketplaces in the country here. At the same time, those people who are downsizing from a big house, maybe to a smaller house, you got to look at this as an asset and as an investment. And hopefully you are. So if you have any questions, you'd like to chat, go ahead and, give me a ring, shoot me an email. I'd love to talk to you. I'd be more than happy to put together a realistic valuation for your property to see if now is a good time to sell. If you're looking to buy, we've got some great lenders who can look at some very, good options in terms of buying down the interest rate. And a lot of sellers are very compliant right now in terms of providing credit. So you can do just that. All right. Well, I hope you're doing well. Again, I'm certainly hoping for an appreciating market in 2023, and have a great day. Cheers.